Now we come to the basis of inventory valuation. How should inventory be valued? Should it be valued at cost, that is the price at which we buy, or at NRV, net realizable value, that is the price we may expect to sell? Cost is the purchase cost, and we will consider all the details of the elements or components of what make up purchase cost in detail in the next slide. But what is NRV or net realizable value? It is the value that we can realize by selling a commodity. However, we talk of net realizable value, which means if we have some inventory on which some work needs to be done, some costs have to be incurred to complete the particular item. Also, in order to make the sales, we may have to incur some expenses. Both these costs would have to be reduced from the selling price to arrive at net realizable value. Let us take a simple example. Suppose we have the selling price of the particular stock in hand is rupees 20. However, this particular item is not complete. There is some finishing work on it to be done. This finishing work would involve a cost of rupee 1 per unit. Also, in order to sell, we need to pay a commission of rupees 2 per unit. In that case, the net realizable value of this particular product would be 20, the price which we will get, less 1, the price to complete the product, the cost of completion of the product, less 2 being the cost to sell the product, giving us rupees 17. Therefore, net realizable value is the price that we will get to sell the product when we sell the product, less any costs of completion and any other costs incurred which we would have to incur if we sell the product. Now a basic question was whether we would value the inventory at cost or net realizable value. We will value it at cost or net realizable value, whichever is lower. So it is going to be lower of cost or NRV. This is in accordance with the concept of conservatism. The concept of conservatism says that if we anticipate any losses, if we expect any losses in future, we should make a provision for it immediately. We should make a provision for it now. However, if we expect to make a profit in the future, we cannot recognize these profits unless the profit is actually realized, unless the sale is actually made. In this particular example, where we had got an NRV of rupees 70, suppose the cost of making this product is rupees 20. When we value this commodity at rupees 17, we are valuing closing stock at a lower price and therefore bringing down our profits. This is because this item which cost us 20 rupees to make or buy, to procure, can be sold only for rupees 17, and therefore we expect to make a loss of rupees 3 in future. Following the concept of conservatism, being prudent, we will therefore value our closing stock only at rupees 17 and not at rupees 20. On the other hand, if the net realizable value was 25, we would value it only at a cost price of 20, because though we expect to get 25 when we sell the commodity, we have not yet sold, sales has not yet been made, profits have not yet been realized. We cannot anticipate this profit and bring it into the books. In such a situation where cost is 20, NRV is 25, we would value the goods at a cost of rupees 20. Thus, basis of inventory valuation is either cost or net realizable value, whichever is lower, in accordance with the concept of conservatism, the principle of prudence.